Hello friends, welcome back to Fin Simplify 360. I am Bishwajit Bose. In our last video, we learned what is a bank and how it works in our daily life. Today, let's go one step deeper. If banks are so important, who controls them? Who is the boss of all banks? The answer is RBI, the Reserve Bank of India. And remember, our aim is to make complex financial topics super easy for you. So let's begin. Now the question is, what is RBI? RBI stands for Reserve Bank of India. It is the central bank of our country. Established in 1935 under the RBI Act 1934. Initially set up in Kolkata, later moved to Mumbai. Think of RBI as the referee in the game of money. It makes rules, monitor, and ensure fair play in the financial system. Now that we know what RBI is, the next big question comes to mind: why was it even created? See, an institution as powerful as RBI doesn't just appear out of nowhere. There must have been some serious problem in our financial system before 1935 that made it absolutely necessary to create a central bank. So let's travel back to the time before RBI existed and understand the problem India was facing in its money system. Before 1935, India's money system was unorganized and confusing. Let's see why. Number 1. Different banks issued their own notes. In British India, presidency banks and some private banks issued their own currencies. Example, imagine if SBI notes, PNB notes, HDFC notes all circulated together. Total confusion. Number 2. No single authority to control inflation and money supply. When too much money entered the system, prices shot up. It caused inflation. When money supply reduced, trade suffered. There was no referee to balance it. Number 3. Financial instability. Many small banks failed because there were no strict rules. People lost trust in the banking system. Number 4. Need for a central regulator to manage the country's currency, credit, and financial stability. A central bank was necessary. Let's understand it with example. Think of India's economy as a school. Earlier, every class teacher made their own rules, like different banks issuing notes. Students, like common people, were confused and insecure. Then a principal like RBI was appointed to bring uniform rules, discipline, and stability. So RBI was created to issue one common currency, control inflation and money supply, regulate banks, and ensure financial stability in India. RBI uses some special techniques called monetary policy tools. These tools help RBI control money supply, loans, and inflation in our country. Let's learn about the most important tools: Repo Rate, Reverse Repo Rate, CRR, and SLR in very simple language with examples. Now the question is, what is Repo Rate? Repo rate is the interest rate at which Reserve Bank of India lends money to commercial banks for the short term, usually against government securities like bonds as collateral. Purpose of the repo rate: if inflation is high, RBI increases the repo rate. Borrowing becomes costlier, people take fewer loans, spending reduces, prices come down. If the economy slows down, RBI decreases repo rate, borrowing becomes cheaper, people take more loans, spending increases, economic growth improves. Repo rate is one of the most important tools used by RBI to control inflation and regulate money supply in the economy. Now, what is reverse repo rate? Reverse repo rate is the interest rate at which the Reserve Bank of India borrows money from commercial banks for the short term, usually by lending government securities. When inflation is high, RBI increases the reverse repo rate. Banks get better return by depositing money with RBI. Banks keep more money with RBI. Less money remains in circulation. Inflation comes down. When the economy needs more liquidity, RBI reduces the reverse repo rate. Banks find it less attractive to keep money with RBI. Banks lend more to the public. Money supply increases, economic growth improves. Reverse repo rate is the mainly used to control liquidity in the economy and maintain financial stability. Next monetary policy tool is CRR, cash reserve ratio, is the minimum percentage of a commercial bank's total deposits that it must keep as cash reserve with the Reserve Bank of India. RBI uses CRR to control the money supply in the economy. If RBI increases CRR, banks have to keep more money with RBI. Less money is available for lending. Liquidity in the economy reduces, helps control inflation. If RBI reduces CRR, banks have to keep less money with RBI. More money is available for lending. Liquidity in the economy increases, helps boost economic growth. CRR is the powerful tool for RBI to manage liquidity and inflation. Now the next monetary policy tool is SLR. SLR stands for Statutory Liquidity Ratio, is the minimum percentage of a commercial bank's net demand and time liabilities that it must maintain in the form of liquid assets such as cash, gold, or approved government securities before offering credit to customers. Purpose of SLR to ensure the financial stability and solvency of banks. If RBI increases SLR, banks have to keep more funds in liquid assets. Less money is available for lending. Liquidity in the economy decreases, helps control inflation. If RBI reduces SLR, banks keep fewer funds in liquid assets. More money becomes available for lending. Liquidity increases, helps boost economic growth. SLR is used by RBI to regulate credit flow, inflation, and overall economic stability. Now take a look importance of RBI in our life. To ensure safe money in banks, keeps inflation under control, makes online payments and UPI smooth, maintains trust in the Indian currency. Without RBI, financial chaos would exist. So friends, RBI is like the guardian of India's economy. It controls banks, manages money, issues notes, and ensures financial stability. In this video, we learned all about RBI, its role, importance, and why it is called the boss of banks. In our next video, we will learn about digital payments like UPI, wallets, and online transfers, explained in the simplest way. If you found this video helpful, do like, share, and subscribe to stay connected with our journey of making finance simple for everyone. Thank you.